Okay, thanks for joining me. Today I thought I'd do a quick video on the additional information you can be given in an income statement or a balance sheet question, because it's every year it's almost the same. They just change the numbers around and change the wording slightly. So if you can master the method and just pick out what you need to know, a lot of it's just context. All you need to do is pick out the numbers, then you can do it easily, very simply. So I thought I'd write some of my own questions and just go through them with you, and hopefully you can follow along. So the first one, rent costs $2,600, so that'll be given to you in the trial balance. 3 months or a 12-month contract worth £1,200, so the whole contract's worth £1,200, relates to the last financial year, which is unpaid, this contract. So 3 months of a contract relates to last year, which we haven't paid, so that means we're in debt basically. So basically that's an accrual. So the first thing we need to do is work out the amount of this accrual. So we need to work out what percentage of this £1,200 contract is an accrual. So I'm going to take the £1,200, which is the full price of the contract. So I need to find out what percentage of that is an accrual, what percentage of that is relating to the last financial year. So I'm going to take the 3 months it relates to the last financial year and divide that by the full length of the contract. So that's simply 300. What's good to do now is to see how it affects each statement. How does that 300 affect the income statement, and how does it affect the balance sheet? I think that's really vital to show to the examiner. So the impact on the income statement is simply, well, with an accrual we always add it to the expense. So the rent is going to increase. So 2,600 plus 300. So the new rent expense, so we'll put rent expense, so it's increased. The new rent expense is now 2,900 to previously when it's 2,600. But how does this 300 now affect our balance sheet? Well, we now have a £300 accrual. And where does that go? Well, that's a current liability. So you see, that's how it affects our income statement and our balance sheet, how it affects everything. Just one little thing, £300 unpaid, it affects both statements, and that's how a balance sheet balances. It changes one side and it changes the other. So that's going to change the profit side, 2,900, and that's going to change our asset side, our net assets. So that's the accruals. So the next one is a prepayment. Heat and lighting cost 1,900, so that's also from the trial balance. 6 months of a 12-month contract worth £800 relates to the next financial year. So let's calculate once again. It's just vice versa basically. Let's basically calculate the value of the prepayment. So the value of the prepayment, well, the contract £800, and we're just going to do how many months we've prepaid, 6, over the length of the contract, 12. So that's 800 times by a half basically, so the prepayment is £400. So I'm going to abbreviate income statement. So the impact on the income statement is simply, it's going to be 1,900. So prepayments, what do we do for prepayment? We're just going to take that away. So take away 400, which gives us 1,500. So that's our new expense for heat and lighting. So it's decreased it in a sense, and our balance sheet, well, we've got a £400 prepayment. And that's going to become a current asset, so it's going to go with our closing inventory, our trade receivables, our bank if it's not an overdraft. So current asset. So basically there you go. Each of these is probably worth quite a few marks, 2 or 3 marks, maybe even 4, depending on the difficulty of it. So just make sure you know the method to that. Calculate the amount of the prepayment or the accrual, adjust the expense, and then make sure once you've done your income statement to always make sure you put it into either a current liability or a current asset. Make sure you always remember that. So depreciation, that comes up on every income statement and balance sheet question. So let's just get straight into it. I've done 2 kinds of methods just so we can show how both are done. So motor vehicles have a cost of £28,000, so that's when they were bought brand new, and the provision for the depreciation is £12,000. Well, what we can already say is at the start of the year, the net book value of the motor vehicles was £16,000, so that's just 28 minus all the depreciation, which is 12, so 16. But we're not interested in that right now. We're at the end of the year now, not the start of the year. So let's work out the depreciation under the straight line method. So the depreciation, so this will be going in our income statement. Well, straight line, so it's simply going to be 28,000 times by 0.1, 10%. So each year we're going to incur £2,800 of depreciation. So that's simply an expense in our income statement. How does this affect our balance sheet? Well, it's going to affect our motor vehicles balance sheet. So how do we work out our net value of our motor vehicles to put in our non-current assets section? Well, it's simply going to be our cost minus all the depreciation that has occurred to that asset. So we've got 28,000 minus 12,000 minus this year's depreciation, which is 2,800, and I believe that comes to 13,200. So that's the new net book value of our motor vehicles. So that's what you'll be putting in your non-current assets account. So I thought I'd do a reducing balance as well. It's a bit more tricky, but it's still very straightforward in a sense. So depreciation, it's just the exact same layout. Depreciation, which will be going into our income statement. Right, well, reducing balance is cost minus the provision that we already have of depreciation times by the percentage they give us. So we've got 28,000 minus the provision times by the percentage. So cost minus the provision for depreciation times by the percentage. So inside the bracket we've got 28 minus 12, which is 16. 16,000 times by 0.25 is the same as divided by 4. So the depreciation this year will be £4,000 expense. So the impact on the motor vehicles account in the balance sheet, well, it's just the same as the straight line method now. We're just doing cost minus all the depreciation, so it's just simply going to be 28,000 minus 12,000. The provision's the same, it's just this year's depreciation is a bit different, it's 4,000. So that's 28 minus 16, so the new net book value is 12,000. And that's depreciation. So I've got 2 more examples and a little question at the end in a sense that I've also written myself. So bad debts of £400 have not yet been accounted for and trade receivables are worth 16,200. When I'm writing these questions out, obviously it will not say in the question, the additional information, trade receivables are worth 16,200. The examiner sort of assumes that, let's take it from my point of view, I read bad debt and I instantly think trade receivables. I instantly think that's going to decrease my trade receivables, less people owe me money. See, the next question, doubtful debts. The second I hear doubtful debts, I think trade receivables. Has it increased or decreased the provision? Will I have to increase my gross profit? Will I have to increase my expenses? It says. So just make sure you know when you hear one word, it triggers your mind to think of another. So here, when you're calculating depreciation, instantly you see the word depreciation, you instantly think net book value. How's that going to increase my expenses? How's that going to decrease the value of my assets? Just make sure you have like a link in your head of the words and how they chain along onto each other. So the bad debt, so that's essentially just going to be a £400 expense. So where are we? So bad debt equals £400. That's essentially just an expense. It's going to decrease our profit. And what do we do with bad debt? Less people owe us money. So our trade receivables, I'm going to use the word debtors. Debtors and trade receivables mean the same thing. You can use them interchangeably. Bad debt we always take away from our debtors. So 15,800. Trade receivables, current asset CA. Also, they might throw a bit of trick in. What if you thought someone was a bad debt, you wrote them off, but then they suddenly come back into business and they can repay you? What do you do with this bad debt in a sense recovered? Well, it's called a bad debt recovered. What you do to it, you'll add it to your gross profit. That's all you'll do, is add it to your gross profit. So on to a bit more of a tricky one, provision for doubtful debt. So I think this is an ACCON 2 question, I'm not sure, I don't think it comes up in ACCON 1. So the first thing to do is just read the question. Provision for doubtful debt is set at 2% of trade receivables, which are £20,000. The provision last year was £600. So first of all, let's just calculate the value of the provision for this year. So the provision is 20,000 times by 2%, so 0.02. And that is 400. So what does this provision do, this 400? Well, this is an average. These are the people we think that won't pay us, these 400. So via prudence, the accounting concept, we're going to take that away from our trade receivables. 19,600. So the full amount of this year's depreciation is taken away from your trade receivables. Don't get the other provision involved yet, but now we will. So we need to calculate the provision change. So we have last year's provision and this year's provision. So this year's provision, and what I'm going to do, I'm going to take away last year's provision. So that's negative 200. So last year's was 600, this year's is 400. So the provision has fallen. Our provision for doubtful debts has fallen. What does this do? Well, this 200 is an other income. We add it to our gross profit. Other income equals 200. We're going to add to GP, gross profit. Say if this year's provision was £1,000, well, last year's was 600, so that's increased from 600 to 1,000, so there's an increase of 400. What would I do with that increase in 400? It's just an expense, that's all it is. £400 expense, and the £1,000 would be taken away from trade receivables. So I've got two quick questions. Returns are always what? What do they do in the income statement? What do you always do with a return in the income statement? Returns are always subtracted. I just realised that grammar's horrendous. Returns always subtracted. No, it's not bad. They're always subtracted returns, no matter what. So if you have a return in, it is subtracted from sales. And out, returns out, would do that. You always subtract it from cost of sales. Just abbreviate that. So that's that. Just always remember, returns are always subtracted. Returns in are going to be at the top of your income statement with the sales. Returns out are going to mean your cost of sales, so they're taken away from your cost of sales, just like closing inventory is taken away. So carriage in, what do we? Oh, sorry, carriage. What do we always do with carriage? Well, it's going to be, well, it doesn't have to be, but it is the opposite. It's always added. So carriage in, well, what you do is we're always going to add to cost of sales. So it does the opposite of returns out. That is subtracted from cost of sales. Carriage in is added to cost of sales. Okay, so out, you're going to add to expenses. And when I say add to expenses, I mean increase expenses. Don't think adding to expenses is good, it increases it. So that's it really. Just make sure you have returns in at the top with your sales, returns out and carriage in with your cost of sales, and then carriage out with your expenses. And that is that really. Just make sure you know your method. Go through the past papers, learn the method. The method is always the same, it's just the numbers are different. So if you're getting it right in one paper, you're most likely going to get it right in the next paper. So just make sure you're being consistent with your method. And as always, emails to my email, and thank you for watching.